So I just want to welcome everybody. I'm introduce who I am. This is Christine Van Horn. I'm a realtor here in Atlanta, Georgia, and I'm starting a nice little YouTube page. And I want to give information about real estate and all the many questions that people who've never bought a home before or people who haven't bought a home in a long time to help answer their questions. And today I have a great guest who is very knowledgeable in the lending department. That's Jamel Romans with United Mortgage Corp. Welcome, Jamel.
Yes, thanks
Yes.
for having me on. I'm
Yeah.
looking forward to speaking today.
Yeah, tell us more about what you do and your role and who do you service?
Yeah, most definitely. As a lender with United Mortgage Corp, we are a broker, also a direct lender. We have funds in house. It just really depends on the deal. Right now, we service New York, New Jersey, Georgia, and Florida, PA, Connecticut, also Texas and Carolina. And if the deal, wherever the deal goes, we can get licensed in that state as well. Right now, we focus on residential loans, commercial loans, and also self-employed individuals, people that are 1099. We help them purchase homes. And then we also focus on the refinance part as well. And yeah, we're in the business of being able to help people. I myself am an investor as well. I was a first-time home buyer before in someone else's shoes, so I can relate to someone who's getting ready to make that home purchase.
Perfect. Yes, I'm
Mhm.
sure it was such a learning curve being a first time home buyer. I remember when my first experience buying a home, it was like, oh my goodness, all the things I never knew that I wish was taught to me in,
Yeah,
I don't know, high school, even college. Like there's so many moving pieces. So
yes.
I wanted to try to get those questions out first, for any of the first time home buyers. So I'll start my questions. So how much should a buyer save to purchase a home?
Yeah. When it comes to purchasing a home, buying a home is a very large transaction and it's not as simple as just going to the mall to purchase shoes or going to the dealership and getting a car. It's best to come to a lender that's paired with your agent that can get you pre-approved and kind of see like your financial fitness, how your credit score is, look over your income verification, your W-2s, your pay stubs, and how much savings you have for the down payment. A great number to keep in mind when purchasing a home. Whatever home you may like is best to have saved at least 3.5% of the purchase price, which would be the funds you use as a down payment if you were to go FHA as a
Mm.
first time home buyer, or you could go conventional, which is 3%. So it's best to have a good rule to have at least 3 to 5% save for your down payment on the home. Also, closing costs will be associated. So I wouldn't really dwell on that too much because you can kind of use different things to help you out with the closing costs. You can use the equity of the home that comes back from the appraisal,
Mm.
which can help a buyer within the closing costs. And that's something called a seller's concession and seller credit, what a seller could contribute to help pay down some of your closing costs. And also something called a gift. You can get a gift from family members to help you out with your down payment. And the gift, there is no limit on what the gift amount can be from a family member that's contributing to help you buy the home. So everything will be okay. Just go through the process with your lender and your agent, and you'll be fine leading up to your home purchase.
Okay. Awesome. And that brings it to me to the next question, but I guess you answered it. What if a buyer's parent wants to help them purchase a home? Would that be
Mhm.
considered a gift?
Yeah, so it could go two options if a person doesn't have enough income or the credit isn't as strong enough, the parent can come on as a co-borrower with them. Also, for up to four people can come on along as a co-borrower, to support. It just really depends on what someone is buying.
Okay.
Someone's situation, everybody's situation is different. But if it's just regular, you have great income, you have great credit, but you just need a little bit more assistance, and you are able to purchase the home on your own, your family can contribute with a gift letter. They just will fill out a letter that's provided from the lender, the amount that they're contributing for the down payment, and it could be a cashier's check. We would just take a picture of that cashier's check, the amount, and just match it up with your file, and we can use those funds for your down payment.
Okay. Awesome. And
Hmm.
you mentioned it all depends on if the buyer has good credit, if they can get a loan on their own. But what happens when a buyer has a low credit score? How can they build it up to make themselves more attractive or
Yeah.
eligible to purchase a home?
Yeah, so if it's a situation where the buyer has a low credit score, they will have to focus on improving that score because the better your score is, the more favorable your interest rate may be. So it's
Mhm.
best, FHA can go as low as 580, um, and conventional can go as low as 620, but both it's best to be over 620 so you can have more favorable terms for yourself. And to be able to prepare for that is to keep your debt low, have less debt than your income,
Yeah.
because a lot of things factor into those debt to income ratios. And when it comes to debt, things are calculated on the monthly payments and not the overall debt. So if the
Mm,
lower you keep your debt, the lower your monthly payments, and it would minimize your debt to income ratio when trying to purchase a home.
okay. I think you went over it, the debt to income ratio. So how does that, so that affects your buying power by
Hmm.
by having too much debt. Like if you, let's say, I don't know, went out and I already purchased a car or something,
Hmm.
and the car payment is $800 a month. Is that a
Yeah.
bad thing? Like, is there a way to change this? Is a situation where I just have to wait a little longer? Just like, how does a DTI, affect the buying power? So I guess it's like that.
Yeah, for sure. So like that car payment situation, the 800 a month is definitely gonna cut into your purchasing power. You might not be pre-approved for a high loan amount because you have such a high car payment, and it kind of will offset what you can afford in your monthly mortgage payment.
Mhm.
Because it's taken into consideration that you have this high car payment coincided with the mortgage that you're receiving. When it comes to debt to income, it's best to pay attention to the ratios on FHA on the front end, and the front end is the income that you have currently. And then the back end is your income minus all the expenses that you have, like a car payment, credit card payment, and also factoring in the monthly mortgage payment now. So on FHA, on the front end, ratio is 46.99, and on the back end, it's 56.99. And you cannot exceed those numbers. If you go over those numbers, you will not qualify for the loan. And on conventional, it's the same, but the numbers are a little bit less, because conventional is like the higher end of the credit score.
Mhm.
The front end is 45 and the back end is 50.07, for the
Okay.
debt to income ratios.
Okay. That sounds
Mhm.
like, I get that now. Now I
Mhm.
understand that.
Mhm.
And I know I explain it to also my clients as well that they don't want to have too much debt. I mean, there's good debt and then there's bad debt. Yeah.
Yes.
So just explaining that to them and like not
Mhm.
having to owe too much.
Yes, and good debt is like if you get a client that has income that they're producing from a business, or if they have investment properties and those things are cash flowing, that income can help with your purchasing power when you're getting a home. So those are good things to have, as a person who's buying a home.
Okay. Perfect.
Mhm.
I want to switch gears a little bit because I know I do have a lot of clients who are they currently own a home and they just want to find out more information. Let's say like if they bought, I know like I have clients that have bought like last year when the interest rates were so high, they were like up to like 8% interest rates.
Yeah.
But now, today they're down to six percentage.
Yeah.
How can they take advantage of like can they take advantage of this lower rate now when they already
Yeah.
bought with the high rates?
Yeah. So on a refinance side, a client can do two things. If they originally have the higher interest rate, the 8%, and right now in present day, we're between like 5.5 and 6, and we're still going down because some rate cuts are planning to happen around election time, which is can be very helpful for a person. They can either do a rate in term refinance or they can do a cash out refinance.
Mm,
For the rate and term refinance, you would refinance into the current present day rates. And if you potentially have equity built up in your home, you can lose the mortgage insurance premium. If you had FHA, you will lose that because you have built up 20% of equity in your home. And you will get the new present day rate of the 5.5 or the 6%. but you still have to qualify for it. You still have to have great credit, and you still have to, be employed with your job because we need to show that you can still continue to afford your monthly mortgage payment.
Mm.
That's one way of going about the refinance, doing the rate and term. Or on the cash out refinance, you can still refinance into the new present day rate to get the lower interest rate and still lose that mortgage insurance premium if you build up 20% of equity. But with the cash out refinance, you are taking cash out of your home from the equity that you have built up, and
Mm.
you use those funds to, have take a vacation, go on to continue to invest, or improve your home. If you want to make improvements to your bathroom or remodel a kitchen or living room or change around some layouts, you can use those funds for that. You don't have to take out all of the funds. You could just take out what you need. So yeah, that's the difference between a cash out and a rate and term.
Okay, that is
Mhm.
awesome. Like honestly, I feel like especially the cash out refinance.
Yeah,
I feel like that's a really great benefit because and some people think like, oh, buying a home, it's like it's not worth it, or I'm just going to continue renting. But it's like, no, 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 you're building equity. But not only are you building equity for like when you're ready to sell it, you don't have to sell your home.
you
If
don't
you're
have
in a
to.
situation of trying to change your rates, you can just do the cash outs
Cash
refi
out refinance, yes.
and do the things you want to do. I mean, it's smart to put some of that money back in the home because that will build
Hmm.
equity more when you're trying
Hmm.
to sell it to do the updates. But yeah, hey, I could get a little vacation, you
Yeah,
know?
yeah.
Why
You can.
not?
Buying a home is not easy, so you got to find a way to unwind and relax. And that's
Yes,
something right there.
definitely. So I know we talked about cash out refinance, but I've heard about the HELOC.
Yes.
I like, definitely been talking about that with my clients as well, as far as I guess like how about you explain it better for I don't want to explain it wrong.
Yeah.
Explain it better. What's the difference
So,
between that and the cash out refinance?
and the cash out refinance.
Get a difference. What is the
Um,
HELOC? Yeah.
yeah, so a lot of people kind of go back and forth on which one should I go with, the HELOC or the cash out refinance. I feel like the differences between the two, the HELOC, and it stands for a home equity line of credit. With the HELOC, is very similar to a credit card. Whatever you take out, you have to pay that back, and you have that payment coincided with your monthly mortgage payment at the same time. So you have two things to pay. You have to pay your monthly mortgage, and you have to pay that home equity line of credit, which is similar to like a credit card. If you use so much, then that monthly payment is going to be really high on what you owe.
Mm.
With HELOCs, they can be beneficial to people that maybe bought in COVID and their interest rates are in like the 3%, and they don't want to refinance until that present day high. Well, it would be high to them, like the 5 to 6 range interest rate. So they want to have a HELOC in case they want to invest or make improvements into their home, or use those funds because they don't want to refinance into a higher interest rate when they have the low interest rate. So that's maybe good for people like that. When it comes to, doing a cash out refinance, the cash out refinance is going to give you a new 30-year fixed rate based off of the cash that you have taken out, and you still have just one monthly mortgage payment versus having a HELOC where you have two payments that you have to make because you have used those funds. And it would be really good for like people that you mentioned before. They have a closer to higher interest rate of 8%, but they can then now cash out and take advantage of the new present day market interest rate right now where we're currently at, and lose the mortgage insurance premium to make their monthly mortgage payment slightly cheaper. And also they have access to those funds with the new 30-year fixed rate, and they still have one payment that they have to focus on.
Yeah, that makes sense. That
Hmm.
makes sense, especially with the people who got a 3% interest rates back in like 2020 or whatever it was. That makes a lot of sense. So
Yes.
they can still like do the improvements if they need the money from their then but like, does their PMI go away or is there like a PMI restriction with the
Yeah.
HELOC?
No, they will still have the same. The HELOC is not like the HELOC is like taking out a line of credit on the side for you to use. It's not like you're refinancing out of your original loan to be able to lose that. You're just tapping into the equity alone by itself, if that
Yeah.
makes sense.
Yep, that makes a lot of sense.
Mhm.
Okay. And then, ooh, I have another question. Reverse mortgages.
Mhm.
How does that work? And who is the best candidate to have that done?
Yeah. So reverse mortgages, that's a great thing to bring up because it kind of goes hand in hand with equity. Um, Reverse mortgages are for elderly individuals. In some states, you can get a reverse mortgage at the age of 55 or older. Others, you can get it starting at the age of 62 or older. And it's best for someone who's like they have just have came out of a 30-year mortgage and their home is completely paid off, or they're getting to the end where their home is paid off and their retirement funds, their social security income or pension might not be enough. This is something called a reverse mortgage where your mortgage is going backwards. Basically, the equity that you have in your home is going to be getting paid to you, the individual, in a monthly check. Rather you paying your mortgage, your equity of your home will be paying you. So you will be receiving monthly income as an elderly individual. But at the same time, you are receiving income that you are owing at the same time
Mm.
money back to the mortgage company because you are using these funds in the reverse. That's why they call it reverse mortgage. So to make go even further into the reverse mortgage is that elderly individual, whoever they will or deed the home to after they pass away, that person will then have to pay those funds back for that mortgage because the home is now transferring ownership to them.
Oh, wow. Okay.
But the best way to go about it is when your elderly family member decides to take out the reverse mortgage, put maybe some term life insurance on them because they're getting elderly, they're up in age. You know, you just things happen. You never know. At least if you know when they pass away, the life insurance policy will then cover that mortgage. And then maybe you can have some funds to make improvements to the home if anything is left over, you know? That
Yeah.
would be like your security blanket as a backup plan for you if anything happens.
Yeah, that no, that makes sense because I was worried. I was like, yeah, because when the elderly's they're getting all this money, who's paying it back? And it's like
Yes.
they're willing it to their grandkids. It's like, wait, you left me debt. I gotta pay back all this money. But yeah,
Yeah.
having some the life insurance policy, you're saying, right? That
Yes.
that's
That's a
a
great security blanket
it
if
is.
their elderly family member passes away. But I wouldn't think of reverse mortgages being like a bad thing for an elderly person because they might need a little bit more income. The Social Security might not be enough, and that income from their home is paying them out, and they don't have to feel like they're forced to leave their home to go live in a nursing home, or if they feel forced to sell their home because they can't upkeep with it anymore. So a reverse mortgage can be very beneficial to them in those ways because a lot of old people that have attachments to their home and they want to stay there. They want to live there because it's somewhere they've been for years. So taking advantage of something like that can be very beneficial to them.
Okay. Yeah, definitely. And speaking about, I guess, willing property to another family member, is that the best way to pass down property, or what would be the best way? Because I've heard different things like, oh, if you will it to a family member, then they have to pay the new taxes, like additional taxes that are much more expensive. So is that true? Like, please clear this up for me.
Yeah,
Like,
it's best for that person to will or pass on to someone in the family that they can trust because they want to keep the home within the family. But once that person gets it, they can decide to do what they want to do. If they want to keep it or if they want to sell it. Whatever that's being transferred from the property is definitely going to follow that person. Nothing is going to be higher with the taxes. Whatever the present day taxes were for that property, that individual is just going to assume that. The city raises property taxes every year, but not any in large amounts. It's just based off of the neighborhood and the equity within that neighborhood. And also the city taxes of different things, the school districts all play a factor. Only thing that I can see that could potentially be high, maybe taxes if they decided to sell the home rather than keeping it. So that's the only thing that might be different.
okay.
Hmm
I guess that's more of a legal. That's legal right there.
Yeah, yeah,
Other ways, 'cause I've heard of different things, but we'll get into that later.
yeah.
But no, it's so great. Anything else? Anything else you come across with new buyers or other recent homeowners? Anything else you want to add?
Yeah, I would say the biggest thing nowadays is like down payment assistance.
Yeah.
But I would like to just point out that it's not a bad thing to use down payment assistance, but just to keep in mind when you do use those funds, it makes your monthly mortgage payment slightly higher because it's 100% financing and you didn't put any money down. So, have your lender run some numbers for you, play out some scenarios and see what the cost would be versus you putting money down and versus you not putting money down to make sure you can afford it. So that's
Mm-hmm.
some things I want to point out about down payment assistance.
Mm-hmm.
Hmm.
That's good. No, yeah, 'cause I know about a lot of different programs out there.
Hmm.
And I introduce it to a lot of my different clients. There's different options because I mean, if you don't have the down payment, or just to see if you can be eligible for something that
Yeah.
hey, it's not all free money, but at
Yeah.
least in that moment, it's good.
Yeah.
It's good. And what else I wanted to talk about, like these Gen Zers, like they have it together. Because, full disclosure, I'm a millennial, and I
Mhm.
don't think I was thinking about buying properties in my 20s. Are you seeing a lot of like 20-year-olds are coming up, like trying to buy properties these days? Not in New York? Because you know you're in New York.
I feel like, yeah, I feel like a lot of this generation has become a little bit wiser with their money, whether with stocks or just investing and starting business in general.
Yeah.
And I have seen a lot of younger people just start businesses and they want to buy investment properties as self-employed individuals. I
Yeah.
have gotten that a lot, rather than, just being a first timer. Because people want to invest. They're trying to figure out the next way how they can generate income. And I think it's really amazing, for someone to be like that. And I also feel like a lot of the younger age individuals are getting into real estate, like becoming real estate agents, home inspectors, home appraisers, and lenders. It's really good to see people like that in the space because I don't know, a lot of the individuals have become older within the real estate industry, and it's great to see younger people jump out there.
Yeah, that is true.
Mhm.
That is really great. I have to have you back on to talk
Mhm.
more about investing. I know you do a lot of you do like a lot of the Burr method and
Yeah.
you do like the house hacking and buying multi-generational homes.
Mhm.
So that's like I have to have you back on to talk about that.
Yeah, yeah, I could touch on it just a little bit.
Yeah.
It's pretty good for a first time home buyer to purchase a multifamily home because you can purchase 2 to 4 unit property and you can live in one unit and you can rent out the other units, and that'll be rental income for yourself to decrease your monthly expenses overall or not pay anything at all because now you have tenants that are contributing to your monthly mortgage payment and you kind of become an investor at the same time while utilizing a lower down payment, utilizing FHA, 3.5% down, or conventional 5% down for multifamily. So it's a great way to get in as a first timer and become an investor at the same time while taking advantage of a lower down payment. Because if a person just jumps out and buys an investment in property, it's going to be like 20% down. But if you could take advantage as a first timer, you can use FHA, put in 3.5% down, or conventional 5% down. So it's a great way to get in.
Awesome. I need to get like that's gonna be my next project for myself
Hmm.
personally. So we're gonna have to talk about that.
Yes.
Getting some investment properties. That's the goal. But yeah, thank you so much. This
Mhm.
has been a great conversation. And I hope to everyone out there this is very resourceful. If anything else you guys were interested in hearing about or you want to see, just let me know. And yeah,
Yes. Thank you for having me. And I look forward to coming on to speak at many, many more.
awesome. Sounds great. Thank you.